Okay, welcome everyone. We'll start our third lesson. Financial and management accounting technique for managers. This is the third lesson. In this lesson, we'll cover LO3, some part of LO3, and remaining LO3 we'll cover in next lesson. So today lessons LO1. Before starting today lessons, quick introductions first, and then we'll start our lesson. So as a couple of you already know me, my name is Anjum Satar and my email address anjum@ukversity.co.uk. If you have any questions, feel free, drop me email. I'll try my best to get back to you as soon as possible. So today lesson is title of the unit, financial and management accounting. So there are the element of financial accounting, which is internal accounting, where under financial accounting is external accounting, where we prepare the financial statement, profit and loss, balance sheet, statement of cash flow, and statement of change in equity. I already discussed during first lesson. And the management accounting, which is internal. Financial accounting is external, management accounting is internal, where normally we deal with the internal costing. Will make the management decisions based on, as the managers, we need to be based on the financial information. We have to make some financial decisions. So all these will discuss different sort of decision based on the investment appraisal, based on budget, and how we can prepare the budget will go through. And I'll discuss with you marginal costing and different costing method. And further we'll go through in next lesson as well, because it's quite big learning outcome, and which we'll cover into 2 lessons. So our learning outcome today, which we be able to apply the management accounting technique. So today we'll discuss different accounting techniques to address LO3, learning outcome 3. 3.1 is about the budget, how we can prepare the budget. Hello. Hello. Okay. So today we'll discuss about the budget, we'll discuss about the budgetary control, why is important budget, and how we can make the budget, on what basis we can make the budget, and what is the difference between budget and budgetary control. So all this will be focused in our discussion today. So we'll start today lesson. So before starting today lesson, we'll a bit recap what we learned already up to now. So up to now we discuss about in understanding financial accounting and accounting system, where we discuss about compare management and accounting systems, analyze the financial management accounting techniques of information, evaluate the usefulness of management financial statement, where I discuss with you all 4 types of financial statement: income statement, balance sheet, cash flow, and statement of change in equity. Second lesson, we discuss about be able to assess business organization performance, where we discuss and we learn about the financial ratios. We discuss 4 types of financial ratios: profitability, liquidity, use of resources, and efficiency ratios we discussed during the last lesson. Today lesson will go through be able to apply management accounting techniques. We have 3 assessment criteria which will go through, and inductive contents of lesson 4, and which will go through first what we're supposed to learn under the lesson 3, and it's unit 4. Hello, welcome.
Hello.
Hello, you okay?
Yep.
Okay, so today we'll go through our LO3, learning outcome 3, be able to apply management accounting techniques. So we'll discuss today, and we have 3 assessment criteria. This LO will be based on 2 lessons, because we can't cover everything in this lesson, so which will do 1 extra lesson as well. Any question? Any question?
No.
Okay, so we'll start. So inductive contents, what we supposed to learn today lesson, and under this LO, budgetary control and budget. What is meant by budget? So which we'll discuss about the purpose of budget, cash flow, cash forecast, budgetary control, different types of budget, zero-based budget, flex budget, variance, what is meant by variance, and how we can prepare the reconciliation and advantages and disadvantages of preparing the variance statements. Costing, and what is meant by costing and cost pricing and different costing techniques. We'll focus on the investment appraisal, and we'll go through investment appraisal method and evaluation, how we can evaluate the performance of organization. All in our discussion will be focused, but some of marginal cost, absorption costing, and some method which we'll cover more in next lesson as well. Any question? Okay, we'll start. If any question, we can go through, but otherwise we'll start. What do we know about the investment appraisal? Any thought about appraisal? What is meant by appraisal?
Appraisal?
Yes. Appraisal. If you're working in an organization, so end of each year we have appraisal. We need to fill the form. It's called appraisal, individual appraisal, to measure the performance of individual, how we performed during the year. Yes. So somebody in some countries is called AGR, annual ACR, annual confidential reports, which is based on individual performance. They kept confidential in some organizations. They don't want to share it, but they only share it to individual, but they don't want to share with others. Investment appraisal. Here, appraisal means checking the performance. Every pound we'll spend, we'll appraise it, how much return we'll get out of it. So that, is called investment appraisal. And we'll go through different types of costs, like it can be fixed costs. What is meant by fixed costs? Like rent. Rent is a fixed cost. Every month we have to pay rent. Either we'll stay in a house or not. We have waste, still we need to pay the rent. Rent is a fixed cost. Variable cost, the cost which change with the level of output, the cost which change with the activity level. Like, gas, electricity usage. If we are living more people in a house, we're using more gas, electricity, energy, so we have to pay more bills. If we are making more phone calls, we have to pay more call charges. Yes, so that's called variable cost. So today's lesson, we'll discuss about budget. What is meant by budget? Any thought about budget? Budget is a financial plan. Yes, we always budget how much we have money, where we'll spend, and how much we'll spend. All we'll make through budget. Every country make budget, every organization make budget, every department make budget. Because without budget, if we don't have a budget, we don't know where the money will come from, where we'll spend. So it's like you're just in a sea and you don't have a nav, where direction you'd go. So budget is a set nav. It provides us navigation. It provides us pathways. It's expressed in the money. It's prepared and approved prior to the year, prior to the activities. Like, a lot of prime minister, they promise we'll do this and that, but always the other party, they ask where the money will come from. We have a budget for it. Yes. So maybe drawn up showing incremental effect. Sometime budget need to be increment. Like, every year we have an inflation. The money we earn this year, the budget required this year is need more budget for the next year. Yes, because we need more money for next year to cover our expenditures. So that is called incremental budget, incremental effect. And question. Zero-based budgeting, every time you start budget from the zero. Every year we'll always assess how many people we have now, how much staff we have now this year, how much we really want to produce, how much we want to sell, all this, and we'll make a budget from scratch. We're not looking last year. If we're looking last year and then we'll say, is a 5% inflation, 5% we need more money to fulfill our requirements. But the zero-based budgeting technique, every time we'll start from the zero. Like a new business, don't have the previous year record, you estimate every year again. That is a zero-based.
Yeah.
Okay, so every organization have a strategy, is mean the action plan, and always we need to back up with the budget. So budgetary control is used to comprehensive system. Budgeting to add the management in carrying out the functions such as planning, coordination, and control. If we don't have a budget, we can't plan it, we can't coordinate it, we can't control it. We're saying we're giving you this money, where you spend us? Yes, you ask, and then we're saying, oh, HR or this department, that department, how much you've been given the budget, what you did. So we can measure somebody's performance against the budget as well. So in our organization, budget can be top level organization, whole organization budget. Then a budget can be at the departmental level. Departmental level is also known as a functional areas, as a called functional budget. And we always measure budget or performance against the budget. Like, in the start of the month, you make a budget, you will spend 1,000 rupees on something, but actually you went to buy the things, you spend it 1,100 pounds. So you spend it 100 pound more. So the budget was 1,000, but you spend it 1,100. Maybe you overdraft, you use the bank debit and credit cards. So now 100 pound is the variance between the difference between the budget and actual. Is the difference is called variance. And variance can be favorable. Its variance can be in your favor, and variance can be adverse, which is unfavorable. So that's sometimes you plan something, but actually you went to buy something and your variance is there. Okay, so budget, classification of budget. Budget can be long term, more than a year. In next 3 years, 5 years, what we'll spend. Budget can be 1 year. Budget can be current budget, is based on the present budget, or the rolling budget. The budget will carry on change every year, or the budget will carry on roll same budget every year. Yes, without any increment. Then according to the functional area, budget can be sale budget. Yes, the sale department will get. Production budget, production department will get. Cost of production budget, yes, how much will cost, we can make the budget. Purchase budget, the purchasing department, they have a budget. Sometimes they say, sorry, we don't have a money, we don't have a budget for this. You request something to buy, like a photocopier for suppose new in your department, and they say, oh, sorry, we don't have a purchase budget for this. So what we'll do, we'll buy next year, because this year we don't have a budget for it. Personal budget, individual, research and development budget. Do we have a Nokia? Anybody have a Nokia mobile?
No.
Do you have a Nokia?
No. Nokia?
No Nokia. No Nokia anymore.
Yeah.
Why not? Because Nokia is not a good mobile?
I think in this age, not good. I think.
Yes. So in the past, all over the world, the Nokia was very popular, but the CEO of the company, Nokia boss, cut the budget on the research and development. Ultimately, they not produce the good, new, innovative mobile. That's why most of the people don't have any more Nokia. They prefer Samsung, iPhone, or various others. Because we need to look around, because if we don't spend money on the research and development, we are not going to produce the innovative things, new things. Capital expenditure budget. Capital expenditure. Capital mean you're buying some asset like property, plant, machinery. If you make a budget for it, that budget will be known as a capital expenditure budget. Cash budget, it means how much money will be in and out of the business. Master budget is overall budget for the organization. That's called master budget. Whole country budget is a master budget. Accounting to flexibility. Fixed budget. The budget won't change, will stay the same. Flex budget, the budget will change. If you are serving more people, if you're making more product, you need more money for it. If the population will increase, you need a more budget for it. So that is called flex budget. Yes, according to the individual, according to the activity. Flexible. So capital expenditure budget, I have mentioned, which is master budget, which is the overall budget. Fixed budget, which won't change. The flex budget. Why the budget? Budget provides the forward thinking, identification of short-term problems. Budget helps motivate managers. If you stay in a budget, you will paid, as a performance. You perform well because you stayed in a budget. If you spend more, they will say, oh, hang on a minute. If you spend more, where you spend it, will be accountable for it. That's called responsibility accounting. Provide a basis of the systematic, coordinate various sections of the business, and provide authorization of the budget. Budget help us planning, communication, motivation, organizing, controlling, and evaluation things. Yes. So all this we discuss why we make the budget. Preparation budget is the first step in a budgetary control system. Implement of budget is the second thing. Then the preparation and implementation budget will not be achieved unless comparison make regular internal actual performance and budgeted performance. The difference will be variance. Continuous and proper reporting system we need to in place. Success of the budgetary control properly follow up action. Why you spend more? Why you need money? Yes. There we need to. Next, we're looking variance. What is meant by variance? Variance is the difference between plan, between budgeted and actual cost. Between budgeted also known as standard, also known as planned. And what is actual? Sometimes you're going to a bazaar and you're going to buy something in the supermarket. You budget something, but actually you went there, the prices increased. Yes. You spend it more than the budget, so that is your actual cost. The difference will be your variance. Okay, variance can be different types of variance. Variance can be material price variance. If you buy the raw material to manufacture, like you want to buy a wood to manufacture the furniture, and the wood price, what you budgeted, but actually you went to market, you buy it, and the prices is more than your budget. The difference will be the variance. Yes. So what you need to do, you need to make sure you have a good information. You know how many suppliers supply the wood. So your variance can be favorable. Yes. So favorable or adverse. Material usage variance. If your staff is not trained and they not handle the things properly, you waste a lot of wood. Yes. So the material usage variance, what you budget, how much wood you will use to make the manufacture the table, but actually you used it more than that. That's the usage budget. Yes, the variance will be favorable and adverse. If the labor is trained, the material usage, they don't waste the material. Labor rate variance. In the UK, national minimum wage was £7.85 last year. This year it went up to £8.25. So the difference between we budget based on the last year rates, but by law we need to pay more now. My budget will be adverse. Yes, I need to find where I'll get the money difference. Yes, I need to cut the either I'll say I'll use less labor hours. I'll try to make my labors more efficient. Yes. So people use less time and people work more and they give more productivity. So we can make the variance. Fix overhead. Overhead is not direct, but is like, accountant fees like advertising fees and these sort of what it should be and where we can look around. Volume, we're supposed to produce 100 unit, but we managed to produce 120. So it means variance is our favor. Yes, more volume we produce. Efficiency, we look around as well, how much we are efficient, how many standard hours we supposed to use, how many actually we use, the difference will be our budget. Capacity, how much was the capacity to produce something. Our workers have 200 hours available, but they use in a way, in that salary we get 240 hours from the worker. And then this is difference will be our variance. It can be favorable, it can be adverse. Okay, variance in the profit and loss account, sales, direct costs and the indirect cost. Direct cost, which the cost we can trace within a product, like direct material and direct labor. Indirect cost, we can't, like accountant fees, like admin fees and those sort of indirect costs. Any question?
No.
Okay, next we're looking cash budget. Cash budget is whenever we'll make the budget, always every budget is based on the sale forecast. If we are forecast our sale will be more, we need more money to produce things, we need more material to produce things, yes, and we are expecting more cash will come when we'll sell more. So we need to make a budget. Budget, this is the question. Typical cash budget will say how much cash receipt we have, how much we pay to the debtors if we are selling things to on the credit basis, how much cash we'll receive from debtors and all. This is will make the budget. So this is the question. We'll go through the question. We have a question. We have a sale, we have purchase, we have wages, we have salary, we have sundry expenses. I'll send you the separate template. You can make your budget as well. Cash, how much cash we have? In first October, 15,000, yes?
Yep.
Second, 50% of debtors. Our debtors mean our credit customer to whom we sold the thing on credit. So how much in July, how much we are selling? 52,000, yes, worth of the sale.
Yeah.
What will be 50% of 52?
52,000.
26,000, yes? Half of it. 50% mean half, yes?
Yeah.
So they are saying the 50% of debtor pay in the end of the first month. So it means the July sale we are selling 52 will get 26,000 cash, but the 26,000 remaining cash will get in the following months. Then exactly the next is the purchases. We are purchasing in July how much? 25,000 worth of the goods, yes?
Yes.
So 50% we are buying from one supplier. So 50% of 25,000 will be 12,500, yes?
Yeah.
So of 12,500, we're not going to pay to our supplier 12,500. They will give us 10% discount on it. So remaining money we will pay. Yes, that's the policy we will set it. And the remaining 50%, which is 12,500, which we'll pay after 1 month. In the new equipment we'll buy in November. Wages we'll pay in 1 week every year. Always we'll keep 1 week wages of our employees. Like in a month we have 4 weeks, we'll pay 3 weeks wages in this month, 1 week in the following months. And we have to make budget for last 3 months now. That's the question. So we'll start the question and we need to make a budget 3 months, yes?
Yes.
Like we have to make the budget, sorry, maybe the month wrong. If we're looking end of the month, okay. Maybe I put the wrong month, okay. If this April, we just consider October, November, December, yes?
Yeah.
So, so what we can do, we can say, okay, how much will be in October? Yes, or 3 months, yes. How much is opening my balance? How much money I receive in that month? Yes.
Yeah.
So that's my total money in the business, which is 54,200.
Yeah.
Then I'll make how much purchases I have in that month, how much wages I'll pay, how much salary. Salary is a fix, yes,
Yeah.
and wages is based on the number of hours. And how much is this? This is so when we'll take the difference between these, we'll say, okay, what will be my closing balance in that month? This is my negative balance because I should pay 85,890 and I'm getting money in that month, 54,200. Yes?
Yeah. Yes.
So it means I need to arrange loan to the bank. Yes? And the next month as well, we need to look around and the following month. So you will see there all these months we have a negative balance. Yes?
Mm-hmm.
So we need to make sure because this 40,000 equipment according to this question which we are going to buy, that's the reason we have a negative balance. What we can do, this equipment, instead of we buying it, maybe we'll say, okay, we can lease it, we can rent it. Yes, so we need to pay less. If we'll buy our own, we need to spend 40,000. So we need to arrange the loan with the bank. If we don't do it, what will be happen? We can't buy this equipment, or will go higher purchase agreement. Yes, so our cash can be. So we need to look around all possible options. Any question?
No.
I'll send you this template. Yes, so we can make the budget. Every organization have financial objective. So objective can be in our organization wealth maximization for shareholders. Shareholders share value will increase. Our company will grow more. More people have a company share. We have a social responsibility that we are not in environmental polluted. We're not involved in the child labor. Yes, all these are objective of the company. Next, we're looking investment appraisal. Appraisal means to measure the performance. Investment appraisal is a business concept which consists of the future income to be derived from the investment. If I'll say to you, can you borrow me £20? No, I will pay you £20 back in 1 year, after 1 year. You're happy to give me £20 loan?
No.
Why not? You give me 20, I'll give you 20 back.
Same price.
Is the same, because you're getting 20 back. If I'll say to you, I'll give you £21 back after 1 year. Is it good now? You give me 20, I'll give you 21 back.
Yeah.
So you need to decide the money you're getting back maybe don't have a value, because after 1 year, the £20 worth of the goods we can buy now, maybe we can't buy after 1 year. Yes?
Yes.
Because the prices will go up. Yes?
Yeah.
So we need to appraise. So there are the different method of appraisal. One is called payback period. One is called discounted payback, net present value, IER, internal rate of return, sensitivity analysis, break even, average rate of. We'll go through 1 or 2 today, and we'll go through next lesson more. Okay? Because we can't cover everything in this one lesson. Huh? Okay. when we'll do investment appraisal is fine, but we need to look around other factors as well, like political, economic, and social conditions. We need to look around internal, external factors. We need to look around financial. We need to look around the cost. All these factors when we'll make the decisions. Yes, political, economic, social, and technological factor. Payback period is a one of what you invest in the business, how long will it take you to get the money back? Okay, this is called investment appraisal. It's very easy. You invest 100 and you get 100 after 1 year back. So your payback period, what you invest, what you get back is a 1 year, yes?
Yes.
In some project, if you invest, like here example, we have two projects, project A and project B. How much money required is £12,000 each. Cash flow, the project A generates 3,000 and 4,000 respectively. Yes? And payback period for project A is a 4 years.
Yeah.
Yes? 3 times 4 is make 12. Yes?
Yeah.
And project B is a 3 years. 4 times 3 that make 12. Yes?
Yeah.
So which project is better? Which we invest? A or B?
A. B.
A. If you invest 12,000. B, yes, because B will takes only 3 years. Yes?
Yeah.
So B is a better because B will take less time. Because what you invest, you get the money back, yes?
Yes.
So B is a shorter is better, okay?
Okay.
Then net present value. If I'll say to you, you give me £10, I will give you £10 back. Actually, £10 value today is a more value. The £10 you have after 1 year. Because the value of dropped, yes? So you always checking the money you're getting, it should be higher value than today date value, yes? In future. Because if you're not getting more value, it's no point to invest it, yes? Okay. So like here, if you invest £10, if you invest £1 and there is an inflation, there is interest, like if you borrow £1 from the bank will charge you interest on it, yes?
Yeah.
If you deposit £1 in the bank will give you interest on it, yes? So you want to check it, your interest should be higher than other things, yes?
Yes.
So saying that because the money, value of the money is decrease every year. So we really want to do, okay, we use the formula, it's called discount factor formula, okay?
Okay.
So we shall go through next slide. So first is the payback period. This is the example. Like here, we're investing £3,100 in the business, yes?
Yes.
Year 0 mean the current year, this year, yes? Year 0 is the base year. Then after 1 year, I'm getting £1,000 back. I invested 31, I'm getting £1,000 back. It means I have still to cover the money, the £2,100, yes?
Yes.
Then after in year 2, I'm getting £900 back. And I was outstanding 21, so still is a 12 left, yes?
Yes.
In year 3, I'm getting £800 back, and it was outstanding 1200, yes?
Yeah.
So still I have end of 3 years is £400 outstanding. So this project will take 1 to 3 years, yes, end of 3 years, still I have outstanding amount 400. But in the year fifth, I'm getting 500. But I required 400 to cover my money which I invested, yes?
Yeah.
So I can't say it will take 4 years. I will say this will take 3 years and some months. So there is a formula. The outstanding amount to cover. How much is outstanding? 400. Yes.
400. Yeah.
In the following year, how much I'm getting?
500.
500. Yes.
Yeah.
400 divided by 500, and then you times by 12. How many months in a year? 12 months. So it will come answer, this project will take 3 years and 10 months, yes, to cover my money 3100 which I invested. So this is the payback period. Any question?
No.
Okay, next we're looking the discount factor. Discount factor mean like a depreciation, because the every money whatever we'll get it, the money is drop the value. Okay. NPV, if NPV will come, NPV stand for net present value. Yes. If is a positive, we will accept the project. Okay.
Okay.
If is come negative, we will reject the project. Yes, we're not going to invest it. So we'll see in the next example now. We investing in this project 20,000. Yes. Year 0 is current year. Present value of 20,000. Today 20,000 is a 20,000. Yes.
Yes.
We use PV. PV stand for present value. Okay. If I depreciate 10%, we need to use the formula 1 divided by 1 plus R. R represent discount factor. Okay. Normally in exam, this table is a given. Yes. So we just write the value. So if you divide 1 in the formula, 1 plus R. R is, we are saying 10%. Can I write 10% is mean 0.1? Yes.
Yes.
So 10% mean 0.1. Yes. So can I divide 1 divided by 1.1? We'll divide. Can you see my calculations now? 1 divided by 1.1. So my answer will come 0.909. Yes.
Yes.
So it means the £1 value will be 909 after 1 year. Yes. After 2 years, whatever answer will come, you carry on dividing by 1.1 with the denominator. Yes. So after 2 years, £1 value will be 8.26. It means 82 pence. Yes. Around. In third year, whatever your answer, carry on dividing. End of 3 years, 0.751. So you can carry on doing this way and we can calculate. So what we do now, if you this column 20,000 times by present value, 20,000 times 1 is 20,000. Yes.
Yes.
5,000 times by 5,000 times by 0.909, that give me 4545, yes?
Mm-hmm.
If somebody say to you, you will get 5,000 back after 1 year, is a 10% value dropped in a year, it means you're getting actually in your hand is a 5,000, but when you go to buy the things, you can only buy the things 4,545 worth of against the 1 year ago the money was, yes?
Yes.
So this is when you add now all these three positive figures, yes?
Yeah.
Second year we have present value of the money we'll get, yes? Third year we have 6008. That's my positive, yes?
Yes.
And how much am I investing? 20,000. So my positive numbers are lower than the negative number, yes?
Yeah.
So negative number higher, yes? So NPV now is minus 3,000.
606.
So 3,000 minus 3,665, yes? So what
Yeah.
we'll do, we reject the project, yes?
Yeah.
Reject the project because our NPV is a negative, yes?
Yeah.
If this will be positive, we'll accept the project, otherwise we'll reject the project. Any question?
No.
Okay, so that is called investment appraisal. NPV is called net present value method, okay?
Okay.
Because in your I included the quiz for it as well, okay?
Quiz?
Yeah.
Yeah. Yep.
If you want to do later on, you can play with it, yes?
Yeah.
Because according to our syllabus, we have 3 investment appraisal methods. So we discussed today 2 methods, okay? If I'll go through the inductive contents, we have investment 3 appraisal method. Oh yes, we have ARR. Okay, now we have 4 methods, yes? Payback, NPV, IER and ARR. Sorry, I think so I deleted. Okay, so next method we are going to discuss about ARR. ARR mean average rate of return. So there is a formula, average rate. It means what will be average we'll get, yes? So is the formula average profit divided by initial investment and times by 100 to calculate the percentage. So we have a question. We have 3 projects. Project A, Project B, Project C. We call Hanover, Bristol and Carlisle. Yes, we are investing 1 million. We are investing 4 million, 4 million and 5 million. Yes, 3 projects. Project A will give us 1 million each year, 1 million back. Yes. So if I'll add 5 year 111, it's become 5 million. 5 minus 4, profit is 1 million. Yes.
Yes.
How many years I'm taking to get 1 million profit? 5 years. Yes.
Yes.
1 divided by 5, so we'll get average profit 0.2 million. Yes. 0.2. What is the formula? Average profit divided by initial investment. Yes.
Yes.
So average profit is 0.2 and investment was 4. So can we say 0.2 0.2, yes, average profit divided by 4 times by 100, yes? So how many percent we are earning profit? 5%. Yes?
Yes.
So we can compare with all options. If the bank will give us 5% and the investment will give us, so we'll prefer to bank because bank is a secure investment, yes?
Yes.
So instead of investing money in a business. So second project we have 5% as well. Yes, we invest. But in the second project, if we'll compare with the first year we'll get 1.5 million, second year we'll get 2.5, then we'll get 0.55, and then we won't get anything. Yes, but it takes 5 years. So second project is better than the first one because we're getting quicker money in. Yes.
Yes.
Even the percentage of the return is the same. Does it make sense?
Yeah.
And the third project is required 5 million. If I don't have a 5 million, I will go first and second option, yes? And I'll prefer second instead of first. But now we have 5 million spare cash. But if I'll invest in project C, I won't get any cash back in the year 1. But year 2, I'll get 0.5 million. In year 3, I'll get 1 point. Year 4, I'll get 2. Year 5, I'll get 3. Overall, my average profit will be 2 because I'll add them 0.5, 1.5, that make 2, 2, 2, 4 plus 3, 7. 7 minus 5 is 2, yes? 2 million. 2 divided by 5, it's come 0.4. Yes? 0.4 divided by 5 times 100, that become 8%. The formula given, yes? So 8%. So if I'll compare with A, B, and C, which one is a better high return? Which one has a high return? C. C give me 8% return, yes?
Yes. Carlison?
High return. I'll get more money back. Return mean investment, huh? On this investment, I'm getting more money back, return. So which is C is the better, yes? So I'll go for C. So thus we discussed 3 methods of investment appraisal. If you want to do some activities, I included. So you can try. Next we're looking break even. What is meant by break even? Have you ever heard break even? Break even is a point, no profit, no loss, yes?
Yes.
So my selling price is how much? 400. My variable cost is 300. So what is the contribution? So first of all, we need to calculate the contribution. Contribution is a difference between selling price, ST, selling price minus VC is the variable cost. So how much is my selling price? 400, yes?
Yes.
What cost me as a variable cost? 300. Contribution is my £100 per unit, yes?
Yes.
So what is my fixed cost? 500 per month, yes?
Yes.
500 divided by 100. So I want to find break even in units, okay? So what will come? 5, yes? It means I should sell 5 units on this price where I will meet my both fixed and variable costs. It means there won't be any profit. Like here, a business is a fixed cost, break even, yes? So it means I must, sell 5 units to be at break even where no profit, no loss. So we call break even in units. Break even revenue, selling price, which is 400 times by 5, which is 5 units. Yes. So if you sell the things worth of 2000, yes, if your sale value 2000, we will be at break even where no profit, no loss. Any question?
No.
Second, we're looking target profit. Target profit formula. Target profit mean if you're doing business yourself, you want to make sure you earn some profit to meet your running expenses. Yes?
Yes.
So fixed cost plus target profit divided by contribution. That's the formula. Okay. So what is the fixed cost in this question? Fixed cost is 500, yes?
Yes.
And I need to find how much target profit I want to. If I'll say I want target profit of, let's say I'll want target profit 1,000, yes, pound every month at least, yes, to meet my expenses. What was the contribution per unit? Because we said selling price minus variable cost, our contribution came 100. So 1500 divided by 100, what answer will come? 15, yes?
Yes.
So I need to sell 15 units. I will be at break even, where no profit, no loss, but within this I will earn £1,000 as a target profit that will help me to meet my expenses. Any question?
No.
Okay, then we have one activity I added. Calculate the break even. A break even point is a fixed cost divided by contribution, and the contribution. So fixed cost we been given is 5,000. Yes.
Yes.
And the selling price we've been given 25.90, and the variable cost we've been given, material is a variable, we need to add these three costs. Yes. And 25 minus 760 minus 1230 minus 1. Yes, that will be our contribution. Fixed cost FC divided by contribution. Contribution mean return. So selling price minus variable cost is equal to contribution. So in this case, which is your, so 25, sorry, is the 5,000 divided by, first you need to solve it, 25.90 minus 7.60, yes, minus 12.30 minus 1. That's your come. Okay. Any question? And whatever your answer will come, 5,000 divided by that. Yes.
Yes.
And then next is 5,000 plus target profit 4,200 divided by contribution, which will be, so we need to calculate. Yes.
Yes.
And that will be limiting factor, because every business have some limits. Yes. Limit can be in terms of labor hours, machine hours. These are called limiting factor, which we'll go through in more in the next lesson. Okay.
Yeah.
So any question? I included the quiz as well if you want to play with it. Yes. Break even. Yes. break even.
Yeah.
Today we learn about the break even point where no profit, no loss. Yes, break even in units, break even in revenue, and the target profit. These formulas we can use, and we discuss about investment appraisal. Any question? And we need to do one more lesson on this to cover remaining bit and pieces. Okay, so we'll keep up to here, and I'll arrange one more lesson, and then we'll cover LO3 full, because it's a lot of things they ask in LO3. Okay, so today we learn about investment appraisal. We learn about type budget and different budgeting methods. Yes.
Yes.
So we'll see you. Any question?
No.
Okay. Thanks for attending today's lesson. Anybody, if you have any question, feel free to drop me email. So please go through, and the remaining elements which will go through marginal cost, absorption cost, remaining one element of investment appraisal IR, and we'll go through remaining elements of break even in the next lesson. And have a nice time. Hope so. I will speak you all by next lesson or during next lesson. Thank you. Bye-bye.
Thank you.